G'day everyone, Greg Canavan here with Rum Rebellion market update for you. Today I want to talk obviously about the markets, but also commodities and the Aussie dollar. I want to put those into the mix because I think they tell a pretty interesting story about where we are with the stock market today. So let's start off with the chart of the Aussie dollar. I haven't shown this one for a little while, but as you can see here, it's been trending down pretty much since the start of 2018. It peaked in January, along with most of the global stock markets. Been trending lower all year, rallied a little bit throughout October and November, hit a new low in December at the start of the year. Tried to rally, but just in the past couple of days, past week or so, bumped into more weakness, and that was on the back of the RBA, the Reserve Bank of Australia, downgrading some growth forecasts. Now, the reason why I've got this chart up to show you is the Aussie dollar is a good barometer, I guess, of global growth and global growth prospects. And the fact that this has been trending lower all throughout 2018, and that trend, as you can see by the moving averages there, is continuing to head lower, albeit at a slightly slower pace in 2019, tells you that there's been no real change in the view that the global economy is slowing down. The other important point to note, and just let me bring up this next chart here to make this point clear, the export earnings of Australia's minerals, so especially coal and iron ore, the prices have been quite strong, volumes have been very strong, and the Aussie commodity exports are expected to earn a record amount of $264 billion in the 2019 financial year. Now, generally when our commodity exports are doing quite well, the Aussie dollar does quite well as well, but that's not actually happening at the moment. So despite the fact that we're getting huge amounts or record amounts of income from commodities, you're not seeing that play out in higher Aussie dollar or rallying Aussie dollar. And what that tells you is that those export earnings aren't flowing through to the economy enough to get the Reserve Bank to firstly change their growth forecasts or increase their growth forecasts, or to talk about raising interest rates. And indeed, just last week, we saw news out of the Reserve Bank indicating that they're moving from a tightening bias to a more neutral bias with interest rates. So despite the fact that we've had really strong export revenue from the commodity side of the market, that's not flowing through into stronger economic prospects for the local Aussie economy. And if we turn back to the chart I just had up, this shows Australia's nominal GDP versus resources and energy commodity export earnings on an annual percentage change basis. The dark line there tells you that the resources and energy export earnings are expected to turn down in 2020 financial year. And the message from this chart is that roughly since the GFC, the nominal GDP growth has tended to follow this measure reasonably closely. So it suggests that nominal GDP growth is going to slow next year, which probably supports the RBA in being a little bit more cautious about growth prospects and the impact on interest rates. So it's why I've been writing about it. I think interest rates are going to fall during 2019. Whether that happens sooner rather than later, I have no idea. But I think certainly there's no real fundamental driver for the Aussie economy at the moment. You've got the expectation for, even though export earnings are quite strong in the commodity space now, they're expected to slow. You've got housing still slowing down, and that's going to have an effect on the economy in 2019, 2020. The reason I bring this up, let's have a look at the next chart. Sorry, we'll go back the other way. ASX 200. Now, I've been talking about this reasonably regularly, saying that I think the rally's run its course and it's about to turn down, and I've been proven wrong week after week. But really, the fundamentals are not pointing to a proper reason why the market rally should continue. Last week we saw the banks get a bit of reprieve from the Royal Commission, and we saw another big rally there. But really, if you look at those moving averages, which is the 50 and 100-day moving average, they're still trending down. Even though the blue line, the 50, has started to turn up again, the overall trend for the market is down. And I do think you're going to see some selling come into the market very, very soon. And that's really on the basis of the Aussie dollar's not, I guess, confirming the move higher in the market. The Aussie dollar's still telling you that global growth is slowing. And I just think that this is a very strong and very convincing bear market rally, which is why I've been writing in the Rum Rebellion that you need to be cautious, not go chasing the rally. I guess stick with the process. If you've got a investment process that's working for you, obviously continue with that, but don't sort of panic into the market just because it's going up day after day. That's what bear market rallies are. They're very convincing, and it pays to, I guess, look a little bit more widely and work out what's the fundamental driver for the rally. And what I'm seeing is that there isn't really one. We're seeing global growth, and that's a bit of an issue. The other side of the market, just quickly, I wanted to show you before I finish up today, the resources index. That's obviously pushed the market higher since the start of the year, along with the banks more recently. But once again, you're seeing this is the ASX 200 resources index, obviously dominated by BHP and Rio. But it's coming up against some longer term resistance that's capped the advance of this or index all the way through 2018. Tried to break through there last week, fell back down. It's hovering around that level, but it'll be interesting to see whether it can break through there. And if it rejects that level and starts to head lower, I think you could see resources probably being the leader of the next downdraft instead of being the banks. Another part of the Aussie economy that's obviously very important is the consumer. So let's have a look at the consumer discretionary index. Once again, that's sold off very sharply from August down through to December, which correlated with a sharp slowing in the Aussie economy around that time. You've seen a bounce back, but once again, if you look at those moving averages, they're still trending down. It looks to be hitting resistance around that red 100-day moving average line. So really, even though you've had a bit of a bounce back in the consumer discretionary sector, the signs there are still saying that the sector's trending lower. And I think, once again, this is a bear market bounce. So in total, or to sum up, there's not a lot of fundamental reason or momentum behind the market. I think it's purely a sentiment-driven rally at the moment. And I think in the next week or two, you can expect to see some more selling. All right, that's it for this week. I'll catch you again next week. Thank you.